Good afternoon and good morning to those of you joining from the Americas. Welcome to the launch of OMFI's Digital Assets Report. In its third year, the Digital Assets Report charts the cutting edge of the progress made to reshape financial market infrastructure with new technology. Our report asks, is the promise of DLT turning into a reality for capital markets? Is the long-awaited revolution here? Through our research, it's become quite clear that the efficiency savings of DLT infrastructure are now broadly accepted, and the majority of market participants expect tokenization to happen. It's also likely that the blockchain bond market will more than double in size between 2022 and 2024. This is evident from our first-of-a-kind blockchain bond league tables featured in this year's report. However, our research also shows that while it's clear that DLT has caught on, change will likely be incremental due to added complexities around adopted new technology. This point is probably most illustrative when discussing the goal of atomic settlement. While the rewards of risk reduction and speed are important, the market may not be ready. Our survey found a preference for longer or variable settlement times as to instant, which we'll go into more detail a bit later. The report further delves into key questions such as what should the central bank's role be in shaping the trajectory of capital markets development? Which assets are likely to be tokenized and why? What is the role of public blockchain in future financial architecture? We invite you all to download this year's edition of the report following the link in the chat box and tell us your thoughts. I'd finally like to thank our report partners, R3 and Stellar Development Foundation, as well as representatives from KfW, Slovenia's Ministry of Finance, Banque de France, Swiss National Bank, and the Hong Kong Monetary Authority for enhancing this report with their insights and experience. I'd now like to introduce our keynote speaker for this event, Emmanuel Usson, Director General of Financial Stability and Operations, Banque de France. Thank you so much for joining us today. Over to you.
Thank you very much, Katie. Good day to all of you. I'm truly honored and delighted to introduce this discussion on the digitalization of assets. So it is far from being a new topic in financial markets, and we have already seen quite large progresses over the latest decade, altering quite a lot of financial markets with significant gains in terms of cost and risk reduction. Let's take one example, FX markets with the algo trading platforms, which is in this regard quite illustrative. But there is quite an important room for improvement which remains. And maybe on our side, from Banque de France perspective, I would like to spot two venues in that regard. The very first one is cross-border payments, which are still low and cumbersome, in sharp contrast with all the progress achieved in the sphere of payments at domestic level. For cross-border payments, it means high cost for the global growth economy as they hinder international capital flows and maintain high costs for remittances. This issue is such a concern that improvement in cross-border payments have been set by the G20 as a prime objective for this decade as far as authorities and market stakeholders are concerned. So we collectively aim to reach by 2027, for instance, an average global cost of 1% at maximum for retail cross-border transfers, and this within a day. The problem is that we are far from being at the objective from the current juncture. We have a second example, a second use case, which is the fact that some financial market segments remain very poorly equipped with mainly manual and costly processes. It is, for instance, the case for funds on registrars. A large part of financial market stakeholders, in addition, and mainly non-banks, still cannot access DVP, delivery versus payment, because they do not access directly security settlement systems. So we might have a plan to address both these issues from our perspective, which is tokenization of finance. New technologies such as blockchains can be an opportunity for simpler, cheaper, faster, and more efficient transactions by promoting further automation for some still cumbersome processes. So we consider that this plan could unfold according to three axes, which I would like to develop in the following minutes. The very first one is the prerequisites. The second axis is the learning by doing approach. And the third one is the need, again, for international cooperation. Our plan is only valuable if it meets several prerequisites, which are all consistent with both price stability and financial stability. The first prerequisite is to ensure that we have the appropriate regulatory framework to foster secure innovation. Without it, innovation can lead to a reduction of the ecosystem. Regarding that issue of regulatory approach, I'm delighted to see that the EU, the UK are adopting approaches on the matter that are diverse in terms of form, but yet similar in substance with the pilot regime in Europe and the digital security sandbox, respectively. The second question is about the preservation of the guarantees offered by the central bank money in a tokenized world. We need to adapt our settlement asset so that market participants continue to use the safest and most liquid asset to settle systemic transactions. The anchoring role of central bank money is critical to our financial stability, and I think that the benefit of the central bank money as a settlement asset for systemic transactions is a hard-learned lesson of the late great financial crisis of 2008. Our goal is to reap the fruit of technical progresses while preserving financial stability. Finally, last aspect on the prerequisite, I think we cannot deny that DLT offer new opportunities, but we also need to examine the impact of their use in the financial ecosystem in a very holistic manner. For example, we have to look at the potential trade-offs and fragmentation and liquidity issues. Let's jump on the second aspect, which is the learning by doing approach, which we have been following in Banque de France. From a central bank perspective, we need to take a proactive stance from an operational perspective, not only from a regulatory perspective, but also from an operational perspective. Technological developments are for us an opportunity to fulfill our cardinal main mission, which is to ensure security and stability and to lever automation in order to reduce operational risk and maintain, for instance, audit trails, which are vital to our regulatory framework. Tokenization and wholesale CBDC can also be part of the answer to current considerations of the public, such as the need for ESG criteria for investments that could be more easily tracked thanks to DLT. This has led Banque de France to launch a very ambitious program of experiments of a DLT-based wholesale central bank digital currency for large value payments as early as 2020. We regularly report on our progress on our website, such as our 2 reports published respectively in 2021 and 2023. This work is now being continued also at the Eurosystem level, which has decided to launch exploratory work to test 3 solutions for the settlement of tokenized assets in central bank money. And the Banque de France DL3S solution is one of them. We have so far tested DL3S and its natively tokenized central bank euro across many trials, but mainly on 2 use cases that we consider central to enhance international markets. The first one is the DVP of tokenized assets and payment versus payments of tokenized money in order to enhance cross-border payments. Our European partners, the Banca d'Italia and the Dutch Bundesbank, have also put forward solutions regarding the settlement of tokenized assets in central bank money by different means than a dedicated DLT developed by the central bank. For the Italian solution, it is the TIPS hashing solution. So the settlement would take place in an infrastructure based on TIPS, which is the Eurosystem fast payment system included in the target services, which is used for settling instant retail payments. And the Bundesbank option, which is called Trigger solution, consists in settlement in target 2, the existing RTGS, the classic one, similarly to the proposed synchronization approach that Bank of England is developing. The security is transferred from one party to another on an external platform, but the settlement of the cash leg of the transaction takes place on the existing RTGS ledger. My last points will address the crucial need for international cooperation. There is a significant risk without international cooperation that the development of new market infrastructures and settlement assets could lead to further additional fragmentation. This is why, in addition to the Eurosystem trials and experiments programs, we are conducting experiments with central banks of other monetary zones. It is both a way to study how DLT and wholesale CBDC could be used to improve international transactions, but also to explore common standards should wholesale CBDC projects go live in the future. At an international level, we are investigating cross-border payments with the project Agora. Maybe you heard of it. This project, launched in April 2024 under the aegis of the BIS, Bank of International Settlement, brings together 7 central banks, including Banque de France, which represents the Eurosystem. There's, of course, the Bank of England, the Fed, Bank of Japan, and others, a couple of others. Among other public and private financial institutions, which are very numerous as well, as there's a lot of interest from notably the banking community. This project will explore further enhancements of the monetary system, the dual monetary system, and provide new solutions, potentially using smart contracts and programmability, while maintaining the 2-tier structure of the monetary system with the central bank money and the commercial bank money. At the European level, we also need to explore the potential of a unified ledger, DLT-based European unified ledger that would include tokenized assets, financial assets, while projecting our 2-tier monetary system with both central bank money and commercial bank money. This unified ledger would be an opportunity to further and deepen and strengthen the capital markets integration that largely remains too domestic as of today. And this would participate in the project of a savings and investment union. which would mean faster, cheaper, and more transparent market transactions in the European Union, which could incentivize investors to purchase non-domestic assets more routinely and improve, as a consequence, our continent integration. Of course, none of those projects intends to replace abruptly the current infrastructures, financial market infrastructures, and in Europe, T2S, for instance, which have been meticulously developed and already provide state-of-the-art services for most of the use cases in payments and securities settlement. But we need to plan forward and ensure that our infrastructures are not only up to date, but also future-proof. And I will stop here. Thank you.
Thank you so much, Emmanuel, for that really useful tour of what's coming and what's already began. I want to follow up on a couple of points you made where we can impose on your time a little bit longer. Firstly, you outlined, I think, 3 proposals from the Eurosystem on settling tokenized assets and central bank money. There is the Banque de France model and then proposals from the Bundesbank and Banque d'Italia. Can you just expand a little bit more on the Banque de France model? Have any key advantages emerged from this trial so far?
So Banque de France model is the sole one among the 3 of them, being completely blockchain native. It means that we create the token, which is a central bank money token, natively on the blockchain, and we have a model which interoperates our cash blockchain, which is DF3S, with a market blockchain, which is the blockchain where the securities, the tokenized securities are. And we make some automatic settlement processes through a mechanism which is a smart contract and whose name is hatched time lock contract, which is an HTLC process. So what we have as a benefit from our perspective and the last almost 20 experiments that we have done so far is that so it's interoperable, but it can be also an integrated system with the securities joining our own blockchain. Which would facilitate even more the DVP or the atomic settlement. And we can provide a lot of different aspects which are quite close to what we provide in our legacy system. For instance, auto-collateralization and partial payment. So it's quite, how would I say, a little bit, it's very like a mimic of what we have in the real world, with different type of underlying technological infrastructure. And it's not only something which rely on a dialogue between the legacy infrastructure, or TIPS, and the blockchains on the security side.
I see, very clear. And on just the use of DLT, it seems that there's been a couple of concerns over the past few years around scalability and resilience. Could you just touch on a little bit more in more recent years how much progress has been made on addressing these challenges? Have we overcome these hurdles?
So we have already seen some improvements as far as scalability and technological problems in the different technological platforms that we have tested. But we have to be we shouldn't be complacent, and there's still a lot of things to do in order to reach the scale of the current infrastructures, because we have absolutely no certainty that we can manage that sort of volumes per second. We have also to make sure that the resilience, the security of the systems are there as well. And so there's the technological things, but also the governance, which have to be addressed in a current way. And we have a lot of discussion about permissioned versus permissionless blockchains, and it's part of the story that we have to consider the way forward.
Yeah, certainly the story is still evolving, and we do touch upon it quite a lot in the report. And final question, it's very intriguing to hear you talk about European Unified Ledger. Can you elaborate as well on this vision and how it might promote a capital markets union and the efficiency of European financial markets? Because this is quite an exciting idea that this concept of a unified ledger is now being looked at from a European scale.
So the thing is that we have already made a lot of things as far as enhancing all the plumbery in the European Union as far as the post-market with T2, T2S, a lot of things. But there are still some pockets of inefficiencies that we see beyond the banks community with the non-banks, funds, and other actors which are part of the financial system, which don't have the same facility to access those very secured types of market infrastructure because they don't access them directly. So here we see the blockchain, the DAT, and a unified ledger. Unified ledger to be unified because on a single platform, technological platform, we could have both the securities and the cash tokens, both commercial and central bank money, which is without any type of precedent. We have both securities and cash central bank money on T2S for the settlement of securities, but we don't have commercial bank money, for instance. And we don't have the whole value chain pertaining to those different assets. And here it would be to make that in the same pot, in the same platform, not to address all the equity value chain, the bonds, the sovereign bonds, etc., which are very well addressed as of today, but to see whether some linkers on ESG, some funds which are still very manual processed, some can be better handled with a lot of additional information, notably with some smart contracts technology, in addition to the facilitation provided by the tokenization. And maybe we have, the very repeated and a little bit not boring, but overwhelming problem of different laws because of different domestic laws. Here we might see as a way to overcome the fact that technology could help with the smart contract handling different laws, maybe, and facilitating the different processes, even for one actor, even for a small actor, which cannot be handled seriously at the current juncture by the tools we have. So that would be the plea for a European unified ledger.
Very exciting and a very good vision, but I fully appreciate your other points on this won't necessarily replace existing infrastructure. It will be working on in parallel, which I think is an important point. Well, thank you so much, Emmanuel, for your time. I think I speak for everyone listening across the world that everyone's got their eyes on Banque de France and all the exciting leading work you're doing there. So thank you again for taking the time today and for contributing to the report. I encourage everyone to read Emmanuel's Q&A with us. It gives even more insights than Shikali has given us right now. So thank you so much, Emmanuel. I'd like to hand over now to Katrina Liu. Katrina Liu is a research analyst here at OMFIF's Digital Monetary Institute. Katrina is going to provide a presentation of the report's key survey findings. We'll then lead into the panel discussion. Do let us know your questions in the chat and we'll address them whenever we can. Over to you, Kat.
Thank you for joining us for the launch of the Digital Monetary Institute's latest digital assets report, this year titled A Long-Awaited Revolution, now in its 3rd edition. I'm Katarina Liu, a research analyst at OMFIF, and I've been working on the report along with my colleagues for the past few months, and it is a pleasure for me to talk you all through the key findings today. This year's report will include findings from a survey of 26 institutions, including finance ministries, treasuries, banks, central banks, and asset managers, and their views on distributed ledger technology and the latest progress in capital markets infrastructure. We will be unpacking the findings across 4 chapters and exploring settlement cycles, cash settlement, asset tokenization, and capital markets infrastructure. Additionally, for the first time for this report, digital assets will also include a digital bond league table, which contains the rankings of top book runners, issuers, law firms, platform providers, and exchanges that have participated in digital bond deals from 1st January of 2022 to the 25th of July, 2024. The rankings are based on the analysis of 39 digital bonds that were issued within this period, with a collective volume totaling approximately $3.83 billion US. So, to kick us off, our survey has found that the adoption of DLT is approaching. We can see this in the chart here, where the light blue portions indicate yes to the question on whether survey participants are looking at adopting DLT and/or blockchain in debt issuance. We can see that the figure has climbed from 29% in 2023, as seen in the top bar, to 38% this year, shown in the bottom bar. Based on this, we expect to see the pace of blockchain bond issuance continue to accelerate. We can observe this uptick in blockchain bond issuance through our digital bond league tables. As I had mentioned in the beginning, OMFIF has analyzed 39 digital bonds that were issued between the 1st of January 2022 to the 25th of July 2024. And the total volume adds up to $3.83 billion US. As of the 25th of July this year, 14 digital bonds have been issued so far, worth $1.2 billion US. Compared to the same period last year, only 10 digital bonds had been issued between the start of 2023 up to the 25th of July of 2023. Although some of the deals that were involved were of larger volumes, which is why these 10 deals totaled to $1.3 billion US. Regardless, the rate of issuance when compared to last year's 10 deals to this year's 14 for the same period demonstrates that the rate of issuance is definitely picking up. If you would like to explore the rankings in depth, where we rank the top book runners, issuers, law firms, platform providers, and exchanges in digital bonds issuances, please refer to Chapter 3 of the report. So to delve a little deeper into the survey findings, we're going to talk a little bit about how the markets as they currently are, how people are working to improve them, and why. One of the key developments this year has been the move to US markets in T+1 settlement. It's no secret that policymakers have long had an ambition to move to shorter settlement times to reduce the risk inherent in the system. Market participants, however, are a little bit less sure. We can see this clearly from this chart. There are split opinions on what will be the most desirable settlement cycle for syndicated issuances for both this year and last year. We can see that for this year, indicated by the dark blue bars, starting from the left-hand side, respondents still show a preference for a lot of longer settlement cycles, where 20% of respondents chose T+3, while 24% of respondents selected T+2, although they're getting more comfortable with the idea of shorter windows. Investors may prefer longer settlement cycles, as many may not have cash readily available to settle a big primary market transaction immediately when a bond is priced. Issuers also might find operational challenges with short settlement. Because of this, for now, 24% of respondents, as shown in the dark blue bar in the far right, believe that settling on demand might be the best option in order to remain flexible. However, the 10 percentage point increase in preference for T+0 to 16% this year from 2023 could be a sign of change to come. Some of the reasons for that hesitancy around to moving to shorter settlement times can be seen listed here on this slide, including workflow processes, post-trade processes, pricing, book building, other pre-trade processes, and allocation. The administrative processes involved in bond issuance remains challenging, with a large number of manual processes required for the preparation and signing of documentation by various different parties. When we asked survey respondents on the biggest inefficiencies in the bond issuance process, workflow processes came out as the biggest, a sentiment shared by 28% of them. In chapter 1 of the report, we discussed this challenge in detail and explore some of the ways market participants are working on addressing it. One of the possible solutions for this challenge, for these challenges, is digitalization. Although blockchain bonds are not strictly necessary for the digitalization of the issuance process, many are starting to experiment with them, hoping for a variety of benefits as an outcome, including faster settlement and more efficient issuance processes. So next, let's examine when market participants expect tokenization to occur. Remarkably, some 92% of respondents believe that financial markets will experience a substantial degree of tokenization. In other words, only a small share, at 8%, seen in the furthest right-hand column, believe that substantial tokenization would not occur. However, the survey respondents who believe that this would occur think that tokenization will only happen in more than 3 years away. The most significant portion of respondents, 52% of them, believe that a substantial degree of tokenization would occur in 6 to 10 years. It is clear to respondents that, despite the benefits of tokenization, the challenges needed to achieve a substantial degree of tokenization are complex and daunting, including involving harmonizing legal frameworks, developing a robust governance framework, in addition to the technical challenges of achieving operational resilience. This can be reflected in the own activities of survey respondents. 65% of them are not working on incorporating tokenized assets into their own operations, while only 15% of them are considering it. The final 20% are presently testing use cases. As we know, bond markets are the furthest ahead in their tokenization journey. So it's no surprise that, as seen in the far left bar of the chart, the majority of our survey respondents believes that this is the most likely asset class to experience extensive tokenization, indicated by the light blue bar. When accounting for survey participants who disagree that bonds are most likely to be tokenized, indicated here by the dark blue bar below, it results in the highest net positive opinion, as shown by the gray diamond, at 55% of respondents. However, other asset classes may follow suit. Survey participants also expect commodities and public stock to be tokenized, as seen in the following 2 light blue bars with positive opinions at 52 and 50% respectively. However, the net opinion for public stock is much lower at 35%, as shown by the gray diamond, due to the extensive regulatory hurdles that need to be overcome before tokenizing public stock becomes feasible. For the other assets, real estate and private credit, they have much more complex legal frameworks, so the journey to tokenization may take even longer. It is important to consider the extent to which blockchain-based instruments might change how markets are structured. We surveyed market participants on how they feel about these potential changes. We can see in this chart, when asked on whether they think that blockchain will become the dominant form of infrastructure for financial markets, 42% of survey respondents agree with the statement, as shown by the light blue bar, whereas 15% disagreed, as seen here in the dark blue bar, thus producing a net of 27% of respondents, as shown by the gray diamond. There remains, however, 42% of respondents who are uncertain that blockchain will become the dominant form of infrastructure for financial markets. When it comes to whether DLT architecture can perform the functions of a central securities depository, a smaller share of survey respondents think so, at 56%, while none actually disagree with this statement. This, however, means that a greater proportion of survey respondents, 64% of them, remain uncertain. As the various pilot regimes and sandboxes progress in their experiments, such as the UK Financial Conduct Authority's Digital Security Sandbox and the European Union's blockchain pilot regime, we may begin to see more opinions of market participants beginning to shift. The role of DLT in CSDs raises a more existential question into their future. Currently, they are responsible for providing regulatory certainty, compliance reporting, asset servicing, default management procedures, and well-established links to corresponding institutions in other jurisdictions. Will DLT infrastructure replace CSDs, or will they redesign their infrastructure to adopt new technology? Some believe that DLT will transform the roles of CSDs, where they essentially remain as an important intermediary, but the operating model will transform by overseeing the issuance and registration of tokenized securities, integrating blockchain technology to manage token lifecycle events, and shift from maintaining centralized ledgers to interfacing with decentralized ledgers to ensure accurate and up-to-date ownership records. So the case for using CBDCs, central bank digital currencies, particularly wholesale, as a cash settlement solution for tokenized assets is clear, where 59% of survey respondents selected CBDC as the option, as shown here by the dark blue slice. There are numerous pilots by the Swiss National Bank, the Monetary Authority of Singapore, and the ECB, among others, that are exploring the benefit of frictionless transactions. Survey respondents have also highlighted the benefit of the reduction of counterparty risk. Other forms of tokenized cash, such as bank-issued stablecoins and tokenized money market funds, were selected by only 23% and 14% of respondents, respectively. Those are the gray and green slices, respectively. Confidence in these instruments is still lacking, and issues around regulation, stability, and risk need to be addressed first before widespread adoption is possible. We also included an option for non-bank issued stablecoins, which was not selected by any of our participants, indicating the bank's continued roles in cash settlement around tokenized assets. And finally, we know of the benefits of DLT, the benefits to DLT. But here I will explore the risks of digitalization. Our survey has found that the perceptions of cybersecurity risks are growing. As we can see in the far left section of the chart, the share of survey participants that identified it as a risk of digitalization has increased to 76%, as demonstrated by the dark blue bars, from 48% in 2023, here shown by the light blue bars. A leading concern here, stated by survey participants, is that new innovations may be incorporated into digitalized systems. New innovations that may be incorporated into digitalized systems might expose new vulnerabilities and can make existing security arrangements inadequate. This highlights the uphill battle for the continued adoption for DLT in capital market infrastructure. Market participants will need to ensure that all of these risks listed here in the chart are considered to ensure continued smooth adoption. So to conclude this presentation, this year's digital assets role of digital distributed ledger technology in financial markets is starting to take shape, as we've seen in our survey findings, where a greater share of respondents this year are looking at adopting DLT and debt issuance. More digital bond deals were issued this year than last year, with 4 deals up from 10 within the same timeframe in 2023. Furthermore, 42% of survey respondents agree that blockchain will become the dominant form of infrastructure for financial markets. However, there is also 15% of respondents who disagreed and a larger 42% who remain uncertain. When asked on the timeline of tokenization, respondents believe that a substantial degree of tokenization would most likely occur at least 3 years from now. This is largely due to the fact that implementation will require significant effort, both technically and in terms of governance. Investors and policymakers have different views on the ideal settlement cycle. Other inefficiencies, largely due to the manual administrative processes involved in bond issuance. Furthermore, there are many regulatory and governance hurdles that need to be overcome before tokenizing various asset classes become a reality. The benefits of DLT in making financial market infrastructure frictionless and more efficient are there, but more work needs to be done to ensure that the long-awaited revolution continues. Thank you, everyone, for listening. I encourage you all to download the report to explore further in depth the themes discussed today and to discover our 2024 digital bond rankings using the QR code shown here or from the links provided at this event. And with that, I'll hand you all back to begin the panel discussion.
Hello, everyone. I'm Liz McClellan. I'm editor of the Digital Monetary Institute here at ONFIF, and delighted to say we're now going to be moving on to the panel discussion portion of today's program. Yeah, thank you to Emmanuel, thank you to Katian, and thank you to Katerina for everything so far. And yeah, delighted to introduce the panel. We're gonna be discussing some of the themes of the digital assets report today. So I've got Johannes Duong here from who's the treasurer at the Australian Central Bank. Good to have you, Johannes.
Hi.
We've got Akinchan Jain, head of asset and liability operations from the World Bank Group Treasury.
Hello.
Thanks, Aki. And finally, Candice Kelly, Chief Legal Officer from the Stellar Development Foundation. Great to have you, Candice.
Good morning. Thank you so much for having me.
All right, terrific. Well, I'll give you all a chance to tell us a little bit about your background and your involvement in the digital asset space. Johannes, can we start with you? Can you give us a little bit of an introduction to your and the Australian National Bank's experiments with blockchain so far?
Yes. So Johannes Duong, my name, and I'm in the Treasury back office. I started as in the risk monitoring unit first, then after a few years I changed to back office, and I'm responsible for cash management and process management and the digitalization projects. And in the recent years, we started more we have an innovation lab in our house, so we can hand in our ideas and projects to create prototyping. And one of the recent initiatives is is the exploratory phase, working together with Banque de France, that we provide our asset platform connecting to the wholesale CBDC platform provided by Banque de France. Just an experiment, so it's only for the mock transactions. Yeah.
Great, yeah, some very exciting work that we're seeing from you guys there. Aki, let's come to you now. World Bank has done some blockchain bonds. I know those aren't exactly your department, but it'd be good to hear a little bit about those and also about your work with World Bank clients in this area.
Yes, hi, Lewis. So at the World Bank, we are, I'm part of the Treasury team. We are a large issuer and investor in capital markets. On the issuance side, we raise about 60 billion every year. That's the money that goes out to middle and low-income countries for development. And then we also manage about 200 billion in assets for our internal and client portfolios. So at the World Bank, we believe we're very passionate about the role technology has to play in development. Just imagine, what's happened with mobile payments, with online education and the like. But within sort of the role we play in capital markets, we feel from our experience, both as an issuer and as an investor, how bonds are issued, settled, serviced, how we invest in bonds, how we custody them, hasn't really changed much in the last 20, 30 years. So we feel that there's a role for digitalization in capital markets. So even back in 2018, we issued what at that time was the first bond to be issued, serviced, and redeemed on a blockchain platform that was working with Commonwealth Bank of Australia, the Australian market. That was a very successful transaction, showed proof of concept. And a key takeaway for us, even at that time, was how we, we wanted to be able to scale it. So at that time, it was CBA's sort of own platform. And we felt it would be important to work with existing market infrastructure providers to do this in a way which is open, inclusive, and scalable for all market participants. So last October, we partnered with Euroclear. They were developing a new digital financial market infrastructure powered by blockchain. So we were the first issuer on that platform in October of last year. Was very well received by the market. And then earlier this summer, we worked with the Swiss Digital Exchange, which is part of SIS, which is the domestic ICSD in Switzerland. For a similar bond, in this case, we also used wholesale CBDC issued by the Swiss National Bank. So what both of these transactions showed was that you can use blockchain in a way which is scalable and inclusive. So a lot of this work informs our work on the development side. So we advise member countries and we make sure that, as we are providing sort of regulatory and policy advice, it's inclusive of digital assets. We're doing a lot of experimentation. We have an innovation lab here at the bank that's working with member countries in that space. And then we also convene, the public and private sector, the think tanks, to shape policy and direction in this space.
Fantastic, thank you. Yeah, you guys have certainly been involved in the space a long time. I remember covering the Australian bond back in 2018, a long time ago now. Candice, let's come to you as our sort of private sector representative on the panel. Can you give us a little bit of your thoughts about what you've heard so far and the progress the public sector's made so far? What, if anything, kind of jumps out at you about what you've heard so far?
Sure. Well, first, I just want to thank you and thank OMFIF for such a great, insightful report. It's always good to have some real survey and market data. And I also want to take a moment, if I can, just to explain a little bit about the foundation, because I think the World Bank and Austrian Central Bank are a little more commonly known. So just at a very high level, the foundation is a non-stock nonprofit, and we support the growth and development of the Stellar ecosystem and the Stellar network. So that is a blockchain network that's decentralized, open, and public. So, and our mission at the foundation is creating equitable access to the global financial system. So we love to be involved in conversations where we see people who are trying to experiment and use blockchain for real world uses. And that's always been our focus. And so I appreciate everything that I've heard in terms of the experimentation and the openness to working with blockchain, and I think that it's incredibly encouraging. I know when I started at the foundation in 2019, one of the first meetings I went to was with the Innovation Lab at the World Bank, and so I know that the World Bank has been really engaged on this topic for a long time. And it's critical that we in the private sector have to continue to develop the technology and show that the technology can meet the needs of the real world uses. And it's also critical that regulators, policymakers, institutions like the central banks and the World Bank are experimenting and giving that feedback, because that's the whole point of open blockchain, is the collaborative nature of it, and being able to have not just small groups of people inside walled gardens making decisions about how a technology should and could operate. And so I do think that all of this is encouraging. When I look at the statistics and the slow, it seems like slow, cautious optimism from the survey participants that DLT can be and will be in certain circumstances. It's not a panacea. It's not the solution to all things. But that, coupled with experimentation by trusted institutions, is I think really the best thing that we can see in terms of adoption and growth of the technology in a really safe and thoughtful way that's inclusive. I love hearing Aki-Jen talking about inclusive in so many different ways. Inclusion of who we're trying to serve, inclusion of who is going to be involved in the decision making and the growth of this technology. So I will stop there, but I'm very encouraged, is the short answer to your question of my response to everything I've heard so far.
Yeah, that's great to hear. I think on that inclusion point, it's great to see the idea of this technology being used to make changes rather than just replicate the current system with incremental improvements, but actually change a little bit about market structures. And the other thing I wanted to pick up on from what you were saying there was, I think one of the things that we saw from the data in the league table is how important the role of the public sector is, because the institutions that are at the top of the league table for blockchain bond issuance are the ones in jurisdictions where the public sector is kind of taking the lead, establishing a wholesale CBDC like Switzerland, or just the more involved they are, then the more activity you can see in the private sector. I think that's an interesting result to come out of that. I want to come on to some other questions, and to remind the audience, we have a chat box where you can post your questions, and they'll be sent through to me, and I can feed them in. We've got a lot to get to, so hopefully we'll get to your questions if you send them in. But I want to start off with one from Adni Ogunsu at Microsoft, who's wanting to get the panel's thoughts on Project Agora. Very timely, obviously. We just had the announcement from the BIS on the private sector financial firms that are embarking on that project. For those in the audience who might not be familiar with it, Project Agora is the BIS's project on tokenization of money, whether that's a combination of wholesale central bank digital currency and tokenized commercial bank money, bringing those together to enable cross-border payments. Excuse me. I was wondering if I could bring that to the panel and get your thoughts on that. Johannes, maybe we could start with you there.
Mm-hmm. So regarding the project Agora, so I heard of this project, but we as OMB, we are involved in another project by the BIS. It's called Project Promisor. So this is the other project, and I heard of the project Agora, but in this project is more. I think Banque de France is more involved in that project, and so for us we are more as a passive role in this project.
Fair, absolutely. Aki, is it something you've been keeping an eye on?
Yeah, it's something we've heard of, seen quite a bit. I don't have direct involvement with it, but just generally on the point, right? We feel helping sort of the topic of cross-border payments is very near and dear to our heart. It's both from a retail level, right, for remittances, for people to be able to send money across the world, but also from our experience in Treasury, where for making sort of payments on assets and liabilities, there is an opportunity for improvement, both in terms of the speed as well as the transparency of information when we make payments. So certainly looking forward to that project being successful.
Yeah, absolutely. I think there's a lot to look forward to there. Candace, please. Yeah.
Yeah, again, we're not directly involved in Project Agora, but the idea of making sure that as projects are going forward, that there is this focus on interoperability, I think is really, really critical. I think everything in DLT, the whole promise of it is that interoperability, and wholesale CBDC, stable coins, like they all need to be able to work together, because as we see when we look at actual use cases, if you look at cross-border payments, which is something that's happening, it's a significant focus of many of the builders in the Stellar ecosystem. Every region, every use case, every community is very different in terms of what they need. Is it speed? Is it the stability of the token? Is it the transparency? Look at the aid use cases, and there's a transparency focus that maybe not as strong as someone who is in Argentina who really wants, or in Colombia who's receiving a cross-border remittances, and the transparency is a added benefit, but it's the speed and the security and the lack of intermediaries and the cost. So making sure that as we are moving into this new world of adopting new technologies, that there is optionality and that there is not this notion of replacing. And I think that's something that the industry has had to really be patient and careful in explaining to the world, to all audiences, because Bitcoin was the first one, and Bitcoin came out saying, we're here to replace existing systems. And at the Stellar Development Foundation and in the Stellar ecosystem, that's never been our mantra. It's we need to enhance, we need to see where the friction points are, where are there ways we can improve, and how do we make sure that all of the systems are interoperable, so we don't end up saying we're going to recreate a new system that has different friction points, that has different silos. And so I think that looking at projects that are taking all of that into account are really amazing, and I'm really looking forward to seeing more of the detailed results.
Yeah, I think that point about optionality is something that came up a lot when we were doing the research for this report, right? That different asset classes. I mean, with it, one potential use case is in financial markets, but even within that, you can kind of break down different asset classes have different requirements for speed and transparency and flexibility and that kind of thing, and having a multiple options is likely where we're headed. Excuse me. On the topic of the appropriate infrastructure choices for financial markets. I wanted to zoom in a little bit on a topic that came up a few times when we were doing the research for this report, and that's, we talk about DLT or blockchain as if it's a single technology, but in reality, there's multiple different blockchain protocols, obviously, and they fall into different categories, and we can kind of loosely describe the public and private and permissioned as well blockchains as that's kind of one framework, though it's maybe a slightly blunt tool. But yeah, I wanted to talk about this because it's an issue that policymakers, market participants are very sharply divided on whether public or private blockchains are going to be which of these is kind of the way to go when it comes to building appropriate infrastructure for financial markets. So Johannes, I wonder if I could start with you on that point. I imagine you guys have been doing tests on both, or both is maybe not the right term, but you know what I mean. Correct.
So in the innovation lab, we tested both on a private blockchain and also public blockchain. So the thing is we mentioned cross-border and interoperability. It's very important. Why we use DLT and why it tested DLT such an effect, because it's a value transfer. Because at the moment, the status quo in the settlement world, we use SWIFT for information transfer to do something. So we have lots of intermediaries to do something, and it's not a value transfer system. But so the DLT should be a value transfer system, right? But in the interoperability, we came. The more we do the experiments, the more we have questions regarding who is responsible for what. In case of interoperability, who is responsible for the gateway? You have two kind of chains connecting via API and if something goes wrong, who is responsible for what? So all this stuff will come to a legal question. And if you have different countries, so you have different legal frameworks, how do you address this? Technologically, it works fine. I absolutely personally convinced of this. But it came up with more and more questions regarding this, because when you have interoperability, you have gateways, intermediaries, who is responsible for this. Maybe we will come back to the old world, the legacy world, that you have fragmentation and all this. So this is something that should be addressed and should be aware of. Otherwise, the DLT technology it will be used in a legacy world that it's not created for this case. It's created for a peer-to-peer transaction. If you put in the intermediaries again, so the thing is, do you really use the DLT in its fully fledged power? And that is something that needs to be addressed. And coming back to the question,
just to make sure that I understand what you're meaning there, using the sort of full potential of DLT in that decentralized model to have a peer-to-peer, you want the widest possible number of participants, which means you want an open public blockchain to make sure you're getting that benefit. Is that what you're getting at?
But it either it's public or private. So the question, here's the question is. The technology is created as a peer-to-peer transaction without intermediaries, so without system breaks, without interfaces, whatever. But in case interoperability, then you have put in intermediaries again to make sure of the quality check. That's necessary because it's also to meet the legal requirements. But the thing is, then you're reducing the power of the DLT of the peer-to-peer. So it's hard to address this, but we need a quality checks. That's definitely, because somebody must be responsible for the issuer. For example, if you issue an asset token on a blockchain, who is responsible for this? The prospects and the financial market authority need institution to take the responsibility, and so on. All this stuff is mandatory and necessary. So if you put all this again in the DLT, then the question is do you can use it really the full power of this technology? So this is hard. It's a hard point. It's not easy to discuss, but this is something that we came up with our stakeholders. We have sessions of discussing this and yeah. And regarding public-private, so we tested on both, and so we cannot. It's hard to say which one is better. It really depends what somebody wants. So if you have a private blockchain, of course you have the fully fledged control over it. Yeah, you know that the stakeholders, who's running their nodes and so on, all these. But if you once deploy your asset on a private chain, yeah, the question is what's happened next? How many transactions happen a day? For example, if you have 5 transactions per day, yeah, just an example, why do we need a blockchain for this? But in case you have an institution deploys this asset on a chain, it has a legal characteristic of this asset. You cannot shut the infrastructure down just in case if there are no transactions. So you have to keep the system running. In parallel, also the legacy system. So you have double infrastructure. In comparison to the public chain, as of course you don't need, you can run a node to synchronize with it, but you don't need to it. You just need a wallet and that's all. But the thing is, you have absolutely no, really limited control over it. Only via the smart contract that you deploy, you create it yourself. You can define the functions and all these, but the infrastructure itself, it's real to control. So you have, you don't need to run your own infrastructure. You can, but not necessary. It's cheaper, but there was limited control. In the private side, you have such a high responsibility because the Financial Market Authority, they will, because institutions in Europe, we have the DORA, the cyber resilience law, that all these need to be met. And it costs institutions a lot. And if you run an infrastructure that it's not scalable, yeah, just only a few transactions a day, the question is cost benefit questions. Yeah. So this is our experience that we come so far.
Yeah, it's a good point, and I guess it comes back a little bit to what we were saying with Project Agora, right? Like it's useful to see a variety of solutions emerging because it's not going to be one size fits all. So probably for specific asset types or classes, different solutions might emerge. It is interesting though, because I think there are people on the side of it's worth bringing up that there are some people who are dead against the idea of the use of public blockchains because of concerns about the regulatory perimeter that you can draw around that, and I think that's something that people are kind of gradually getting a little bit more comfortable with. But Candice, can you talk a little bit about? I imagine you guys have heard all those objections and probably feel like they're answerable. So it'd be good to get your perspective.
Sure. Yeah. Thank you so much. So I think that there are some common misperceptions about the public versus private. And I think some of the discomfort is that we've all lived in a centralized world. And to be able to really understand the benefits of decentralization and thinking about, instead of having all of this responsibility, as Johanna said, be in a small number of people. That's what we're used to. And it's good until it's not good. And there's a single point of failure, there's a single point of attack. And so having it be decentralized and having this collaborative approach with people all contributing, developers and businesses all contributing to, and having more eyes, right? Security is something that is only going to continue to get more challenging. Blockchain, the underlying infrastructure of blockchain has not failed yet since Bitcoin was started. Now, Johannes was referencing bridges and things that are like some of these intermediaries. And I think that we have to remember that it's like, think about it more like there's the internet, which is decentralized, and it's a public good. And DLT should be a public good. And then it's figuring out what layers on top of that will need some form of regulation. So a very simple example is an asset issuer. There are plenty of stablecoin issuers that issue assets on the Stellar network. It's separate. It's embedded in the code. You don't need a smart contract in the Stellar technology stack to do that. But the issuers, there needs to be regulation. And I think the lack of regulation, clear regulation on that to date is part of why we see some of those statistics that came out in terms of the hesitancy of saying, oh, well, we want central bank digital currencies over stablecoins, because there is a certain amount of regulatory oversight that needs to be at certain layers in the stack. And so it's not an all or nothing proposition, but if you build it all on something that is open and that you have multiple entities who are constantly looking at it for security concerns and who can't make unilateral decisions, which is really one of the most critical things, is that the protocol is what determines how the consensus mechanism works. Very different for different networks, but certainly in the Stellar network, it's not based on how much nobody makes any money by participating. It's not based on how much of a certain currency you have or how much computational power you have. It's based on trust. The nodes actually have to say who they are. And so there are different governance mechanisms, there are different protocols, but at the core, it's decentralized decision-making. So there aren't those single points of decision-making, attack, failure, that again, it's making sure it's not an all or nothing, just like we're not replacing all financial infrastructure, not replacing every layer with completely uncontrolled, permissionless. Some of those words are just very uncomfortable until you stop and really think about what they mean. And what it means is getting away from some of that centralized control, which comes with some downsides.
Yeah, it is interesting because I think policymakers, monetary authorities, financial market infrastructure have got used to the capacity to make unilateral decisions and love making unilateral decisions. So it will take kind of a mentality shift, I think, to see that as a strength and not compromising their ability to oversee the market. Aki, I'd like to come to you as well on this point. I think what you were talking about, the accessibility and broadening access, it seems like that's something that people typically go to the most open type of models for, but yeah, be interested in your perspective there.
Yeah, so I think both Candace and Johannes have made some really good points. I mean, on the World Bank side, like I mentioned, the 3 transactions we have done, they've just happened to use private and permissioned platforms. We feel public financial market infrastructures are systemically important. So what is critical in this space, right, in the fixed income space, is to get the trust and confidence of the market, right? So again, some of the legal and regulatory aspects with public sort of platforms still need to be ironed out. But yeah, so far our experience has been more on the private permission side.
I see. And you're not kind of closing the door to participate in the public side. Yeah.
It's a space we are following very closely.
Yeah. I want to come back to an audience question, another one from Adenio at Microsoft, and he was asking about the risks that are posed by digital assets and tokenization. And I wonder if, what we're talking about systemically important markets here, right? Like this is, it's big money involved, the markets, the ensuring that they can't be compromised is going to be key to deploying this in a manner that people are comfortable with. Candace already alluded to the challenges of cybersecurity becoming more complex. I'd be interested if Johannes, you've got any thoughts on alternative challenges, well, other than cybersecurity, or even within that, how you guys are thinking about mitigating risks if you're moving to this kind of infrastructure. So
the risk is as I said, as a private institution in the European Union, there's a Cyber Resilience Act, DORA, that need to be met for financial institutions, and to meet this is a really high effort. So that's why what in our case, what we are doing in our experiments is we want to contribute our experiments with institutions, also with the ECB. So when we experimenting with public chains, there are also another risk that need to be is the transaction fees, for example. I mean that it's hard to calculate this and or in case of scalability is that when Candace, you mentioned Bitcoin is decentralized, it's a peer-to-peer at the beginning, but the thing is how many transactions could be done per second, and so there was a Bitcoin Lightning, yeah, for these and second layer solutions, and also changing of consensus mechanism from proof of work to proof of stake. But looking at all these components, we see this is more coming to a centralization. Yeah, when we look at the second layer, there is no blockchain behind it. Yeah? It's just like more a clearing when we're looking at Bitcoin Lightning, and also the consensus mechanism for proof of stake for Ethereum is changing, and all this when we are monitoring this, so we see that once when it's scaling, that it's more getting to more centralized ways. So because maybe the decentralization is hard to manage this stuff, but all this is something that we are still exploring. So this is what we want to say is just from our perspective and our experience working on this. So of course there are other opinions on this, but what in my case is I just want to share our experience on this.
Yeah, no, that's it's very valuable. Candice, I'll give you a chance to respond to that on scalability.
Yeah, so both scalability, I want to actually talk about both scalability and transaction fees and resilience. So I do think you bring up proof of work, proof of stake. I do think that this is something that everyone really needs, if anyone is experimenting in this space, to really understand the differences between the consensus mechanisms. The Stellar network is neither proof of stake nor proof of work, and it is, we call it proof of agreement. It's its own, the Stellar consensus protocol. And transaction fees, the network was launched in 2014. Transaction fees are a fraction of a penny for 50 to 100,000 transactions. So, and those transaction fees get burned. They're not, nobody is profiting from them. And so it really is important to understand what are the motivations of the people who are participating in the consensus mechanism. If the participants are not making money and they're not, but they are participating because they find that the technology is valuable and solving problems, and those who participate in the consensus mechanisms and the nodes in the Stellar network are also, it's the same consensus mechanism that is used to make any changes to the underlying protocol. So you're validating transactions, but then if someone in the ecosystem says, hey, we should change the transaction fees, or we should change the protocol in a certain way, the entire network needs to reach consensus on that. It's not a small group of actors that need to. And so to me, it's really a question of there's a amazing evolution. You start with proof of work with Bitcoin and then proof of stake. Yes, the transaction fees in proof of stake and the speed, right? Bitcoin may take 10 plus minutes to be able to reach settlement finality. Whereas if you look at a different consensus, and obviously I know the Stellar mechanism. So it's not for every. It's not a solution to every situation, but transactions are 5 seconds is the average transaction speed, and so scalability, I think, is also very closely tied to the governance of a particular network. And then just lastly on the resilience and security point, I again go back to it's the protocol level. I mean, even Bitcoin has been down. I think it's been down for a total of 15 hours. In the Stellar network, there in 10 years, there were 67 minutes that the network has been down. And there have been other instances where certain validator nodes went down, but because it's decentralized, transactions continue to take place. So again, I think it's really there. We sometimes talk about this technology as being around for a decade or more. It's really not that long, particularly because of there's the pace of innovation in this space is so fast. And again, conversations like this and the feedback loop that needs to happen to get to a place where we really understand, like, what are we going to optimize for financial markets? Maybe that's different for NFT markets. Maybe that's different for cross-border payments. But having these open networks means that things can evolve, and all of the participants, whether those, because the World Bank and the central banks can also participate as nodes in these networks and have a say in the consensus decision-making of the governance.
Yeah, I think that point on the difference there, the differences between types of blockchains and the consensus mechanisms they use are really material for the how the business models that we involved and the core functions, and then as you say, a lot of the problems that we've seen so far in decentralized technology is not really around those core functions. It's around the ancillary services, whether that's wallets or interoperability bridges, that kind of thing. But yeah, it's going to take a long time for people to get comfortable with that kind of thing. Aki, is there anything you'd like to add on that, or we could move on to the market infrastructure point?
No, we can move on. I just want to say that, again, it's, I mean, like Candice was saying, we're still in the relatively early stages, right? And so what's important is to build confidence in the market. The transactions we have done, we've always sort of built in fallback mechanisms, right, to make sure that if something, if the system's down for some reason, there is an alternative way to still be able to service our bondholders. That's a feature which has been also very well received by the rating agencies that have rated our bonds. So all that is just important to build trust in the market.
Yeah, I think that's a really good point as well. Okay, yeah, let's talk about market infrastructure, because I think it's not just the assets themselves that are potentially changed or reshaped by this technology. One of the topics that we talked a lot about in the lead up to this report and in the report itself is changes to the way we organize market infrastructure and who provides what services. I think going back to the Bitcoin was originally about peer-to-peer value transfer with no intermediaries whatsoever, and finance doesn't work like that, right? Like the world of finance has been built on having trusted intermediaries to perform services, and I think it's been kind of interesting to watch blockchain development within the capital market space, because I think a lot of it has been about rediscovering the importance of the role that some of these intermediaries provide, but then still that doesn't mean that they're not capable of being disrupted, or that there aren't changes that are going to come to them, whether they like it or not, as a result of new technology. Aki, maybe we could start with you on this. I'd be interested in your perspective. Obviously, you participated in the DFMI project with Euroclear, and CSDs, I think, are kind of on the front line of what people originally thought would be perhaps disintermediated by DLT, right? And I think with the European blockchain pilot regime, the UK digital securities sandbox, part of the point of those pieces of legislation is kind of to test that thesis. But yeah, interested in your perspective on that.
Yeah, it reminds me, Lewis, of when we were sort of talking to investors about one of our transactions, and their question was, well, but you're not disintermediating anyone here, and for us, it's been less about disintermediation. It's more about efficiency. It's always been about efficiency. So if you look at like the end-to-end process, right, from an issuer to an investor, right, there are multiple players that are involved. So we, as an issuer, we're always working with a bank, which is underwriting the transaction. We're working with a paying agent. We typically have an independent calculation agent on our issuances. From there on, it goes to the ICSDs, and then to a custodian, and then to an investor, right? Now, if I, so if not tomorrow at the World Bank, I mean, we could do a, leveraging sort of technology, we could do a direct issuance to investors. But we feel banks play a very important role, right, in as market makers, certainly from a KYC standpoint. So there is that role is super important. The role of an independent calculation agent is very important. So now let's say if as an investor we had invested in a blockchain bond, and let's say there was no calculation agent or trustee or any of that service, and I've not come across a single system which never has any downtime or never has any bugs. So now if let's say I'm expecting a certain coupon and I didn't receive as an investor what I was expecting, And I go to the issuer or to the CSD, and they say, well, this is what the system came up with, right? This is what the smart contract calculated. But if it just doesn't make sense, I do want to be able to speak to someone, to be able to hold someone accountable. So we feel it's less about disintermediating roles. The roles are the roles, they still need to be performed. There may be, at the edges, some things which can go away. But we feel that every participant in the capital markets sort of ecosystem does play an important role. And what we can do is use technology to create more efficiencies, use a single set of data, for instance, rather than more disintermediating any specific roles.
Right. Yeah. No. Absolutely. Johannes, let me come to you on that as well.
Mm-hmm. So thank you. Yeah. So as you mentioned, Aki, there is a value chain behind it, and investors, CSDs, and so on. So from my perspective, or the perspective that in our working group with the Austrian bank is that we differentiate between traditional financial instruments like government bonds or equities or this, and the new digital financing. So for the traditional assets, so we have a business stream. We have different streams working on in our project. So in a business stream, our business colleagues always say, hey, is there any business cases for the traditional assets on a blockchain? So very important is the secondary market. Yeah? They need to bring the assets to their private clients and so on to have an uptake. So, and for the private client, when I'm looking, okay, I'm buying a bond via my application. If it's a blockchain or not, I think it's not really a matter. Yeah, for him, is the profit the most important thing. So that was the question: what are the business cases behind it for the traditional side? So maybe from the one is the efficiency. What you mentioned, Aki, is the efficiency. So what could cost be reduced using blockchain for the legacy in comparison to the legacy system for traditional financing? So from our perspective, it's really hard to calculate because each institutions we are working together has its own infrastructure and legacy systems. So you have reconciliation processes, all these. So when we're using a DLT, maybe reconciliation still have if the issuer cannot pay his coupon. So it's independently of the technology. So it's for us a big challenge to address the cost via DLT for traditional assets, because at the moment, we can settle it real time in a euro area. So it's time to zero already. So, and we do not really have much problems regarding the settlement process. So to challenge this, I think it's quite difficult for the DLT. So that's why we separated it to new digital assets classes. So here that could be interesting, that new markets could come up, new asset classes that coming hand in hand with DLT. So there are two focuses in our perspective. So, and here is important, what are the business cases behind it? For example, Candice, you mentioned NFT business. Usually at the beginning there was a big hype, everybody was talking about NFTs, but now or metaverse, all this stuff. But at the moment, seems that not really many people talking about this. So creating a business, not only a use case. Yeah, the use case one thing, but the business case is more important, because commercial banks, they at the end they need profits for what they're investing. So creating a business case based on that, I think this is also a big challenge for it.
Yeah. The NFT craze was really an example of people getting excited about a medium without any actual value being applied within that, or it was only what people were interested in was primarily the medium itself. And I guess if it's going to take off as a medium, it's got to be a vehicle for business use case, as you say. Candice, let me come to you on the question of infrastructure. You've already said you're not in the business of looking to disintermediate or replace the existing system, but are there some areas where you feel like the technology can kind of automate something that is currently done by a particular infrastructure, that kind of thing?
Absolutely. I think that, intermediaries do play an important role. Aki Jim mentioned KYC, right? That needs some sort of, but I think it's rethinking where and how, right? If you start with cross-border payments, and there are efficiencies, and you can kind of have that KYC and the compliance at one part, and then remove a lot of the intermediaries that we see. The UNHCR uses the Stellar network to deliver aid in Ukraine to internally displaced Ukrainians. You don't need a bank account, and it's instantaneous. And you can't think of a better use case, I don't think, than aid, of something that needs to be fast and not have to worry about what is the status of the bank. I mean, when we first started working and helping the UNHCR build this solution for themselves, the war in Ukraine had just started, and there was a big question about whether, is Hryvnia going to be there? Are the banks going to be there? As it turns out, now there's optionality, and these folks can receive their aid. They can actually use an ACH wire transfer and get it into their local bank, or they can walk into a MoneyGram location and cash out. So that's a very obvious case. Then you shift into, Franklin Templeton has the Benji token, a money market fund issued on the Stellar network. And that, to Johannes's point, they have significant efficiencies and cost savings by not having multiple systems to do something that one system can do. And they also are a very good example of this slow process of adoption and being careful and having a backup system, which they no longer have to have a backup system. It's all on the network, the Stellar network. But and they now have peer-to-peer transactions. They have changed it so the minimum investment amount is $20. So the efficiencies drive different uses that may not have ever been imagined. And so I think it's important to really think about, again, where are those intermediaries really important, and where can it be automated? Where can something even as simple as not having 4 databases, but having it all in one place that's transparent? So again, it's not a let's replace one thing with another. It's let's look at where are those friction points? Where are the intermediaries really important? Franklin Templeton is still doing their due diligence and making sure that the folks who are interacting with the assets. And one last point is, I think, just separating out like what you can put into the controls in an asset. You have a stable coin that doesn't have any controls. It's a freely tradable asset on a network. You have a tokenized security or a tokenized money market fund. There are controls that the issuer builds in. So they're still operating on this open network. They still are reducing the number of intermediaries, and they're still maintaining control. They can freeze, they can claw back, they can take care of all of those challenges that a centralized actor needs to when they have a particular type of asset. So it's really constantly rethinking what are the requirements and how can we meet them with these different tools in our toolbox at this point.
Yeah, understanding what the technology actually enables that previously required something centralized. And yeah, I think the Franklin Templeton project is so interesting because you see that happening within a single organization, and it takes a lot longer for that to spread throughout a marketplace. We're almost
and it takes a long time to get the SEC on board, but once they do, hopefully that, and that's the thing, you have to have these pioneers who are willing to take that time to build that trust. And as I said in the beginning, having the World Bank and having the Austrian Central Bank and others experimenting with this is really, I just see this as converging in that everyone moving in the same direction of building the trust and recognizing where the real risks are. That there are risks in any system.
Well, let's talk about that timeline. It was something that we asked the market participants in our survey. Nobody said tokenization would be, substantial in capital markets within 1 to 2 years, but very few people, only 8% said never. Almost everyone else, 92% said 3 to 5 or 6 to 10 years. Do you guys broadly agree with that? And I guess, are we on the trajectory for achieving that at the moment, or are there still some quantum leaps that need to be made in what the technology can deliver for us to get there? And I think we'll probably have to wind up after this. So any final thoughts? Johannes, let me start with you.
Yeah. So for the final thought is, so I think this scalability is definitely one of the key points for take up or not. And the second thing is that our business cases, so that why should an institution invest in a DLT technology? Because finally it must be a return on investment. So the question is, what are the business cases calculated? The longer the better, and all these stuff need to be to gain the trust that they invest. Otherwise, we're experimenting a lot. Technologically is fine, but the thing is the key question finally is the scalability, the real business cases behind it. So finally, the institutions, they want a return on investment, and all these need to be clarified. And the regulatory, of course, because nothing can take up without regulators. This is the reality. Yeah. And in the financial market side, so to meet the regulatory framework, it's also a big challenge.
Yeah. Yeah, well, the regulators tell us they're working on it, and I think we can see some progress there. Candice, some final thoughts on the trajectory we're on for tokenization from you.
I think we're on the right trajectory. I always would like it to be faster, and but I do think that it is a combination of both us in the industry continuing to help educate and make sure that people understand what the differences of different technologies and what the application to real world uses are, making sure, as Johannes keeps pointing out, that this is actually a good business case. It's not just a philosophy of openness and decentralization, that actually is creating efficiencies and solving real world problems. And I think the big piece that we haven't really spoken too much about today is regulation, and making sure that we are all working towards really smart regulation that focuses on the places where we do need that oversight, and we do need, as you know, the intermediaries, the folks who but allowing the innovation and allowing that underlying infrastructure to be open and decentralized and public and accessible. So we have all eyes on that, contributing to it, and that the various use cases and the assets and the different pieces do get the appropriate amount of regulation. And we're continuing in the industry side to contribute to that conversation and see some really great progress in different regions. So
yeah, absolutely, it does. We hope it's coming. Aki, any final thoughts from you on that? Thank you.
Yeah, I'll echo what Candice and Johannes said. We are on the right trajectory. There is, I think the technology is clearly there. The the private sector is there in terms of the solutions and options available. On the legal and regulatory side, there is a lot of work that has been done. Certainly with our issuances, we've seen, come a long way. We've now issued under Australian law, under English law, and Swiss law. So there is, a lot of central banks are looking at this. They're looking at CBDCs. We didn't talk much about that today, but a lot happening there. The one area where I think we need to do more is what's in it for investors. So if I'm an investor on a bond, issuers are doing this, technology providers are doing this, banks are doing this, but in terms of real functionality or value add compared to where things are today, we can do more for the investor. But overall, I think we are on the right path, and it'll take some time, but we'll get there.
Yeah, absolutely. Yeah, I think that's a really great point.
One more short point is also one in our discussions with our stakeholders is also the existing, for example, regarding government bonds or bonds on the legacy world. When you use DLT to migrate it on the other platform worldwide, it's also a very big challenge, because we have lots of bonds that are issued already before the redemption. So maybe new issue and bonds on a DLT is easier, but to migrate one to the next, is a chain of legal questions also regarding on this. Something that is also a big challenge, how to the migration phase for the traditional side. So
yeah,
keep in mind.
And there's a few 100-year bonds floating around out there, so we can't just wait for them all to get paid back, right? Like that won't work.
Absolutely, we have 100 years bonds, I think, issued in Austrian Republic also.
Yeah, you guys.
It's not easy. Yeah? It sounds like easy, but definitely lots of legal aspects there.
Yeah, absolutely. We're well over time now, so we'll have to leave it there. Thank you, Candice. Thank you, Yannis. Thank you, Aki. It's been great to have you guys. Great to have your insights. And thanks also to our audience for coming today. Thanks for sending in your questions. Apologies we didn't get to all of them. Please do download the report, get in touch, let us know your thoughts. We'll have a lot more coming in this area. Yeah, you can check on our website for upcoming events and roundtables and things like that on this topic if it's something that interests you. And yeah, I hope you enjoyed today's panel as much as I did. And yeah, thank you again to Johannes, Candice, and Aki.
Thank you.
Great to have you guys.
Thank you.
Leave it there.